Okay, so hello and welcome everyone to today's AFM P4 webinar. This webinar is conducted by us usually 1 week before the exam date. Obviously, you have exams later on. The purpose of this webinar is to just attempt one 50-mark question, latest question, which helps you revise some concepts and also puts one question burden off you that, okay, one question I've practiced with the tutor. Okay, now, obviously, since these webinars are free of cost, so there's too much crowd willing to enter it, but obviously we have a limited capacity to accommodate students. That's why I can see many students in the waiting room. So let's just first spend 2-3 minutes. You need to wait so that we can organize all the stuff, and then we will start doing one question. Okay, please hold on. Okay, so I think now we should start our class. And I apologize to those who are unable to join it. Anyways, the question which we have planned to do for today, it's a question of mergers and acquisitions. So my priority is basically to cover mergers because people find it technical. It's from March 2020 attempt. It's question number 1, called Westparlay company. Okay, so if you want to open it on your devices, you can just go on the ACCA website and use that. And if you want to just follow it on the screen, you can, because obviously on the screen, the whole question cannot come. So if you want to open, you can as well. I'm giving you 1 minute and then we will start. Okay. Okay, the question states that Westparley Company is a listed retailer, mainly selling food and small household goods. Okay, it's a listed retailer selling food, small household goods. It has outperformed its competitors over the last few years as a result of providing high quality products at reasonable prices and also having a stronger presence online. It has kept a control on cost partly by avoiding operating large stores on expensive city center sites. Instead, it has had smaller stores on the edge of cities and towns and a limited number of larger stores on convenient out-of-town sites, aiming at customers who want their journeys to shops to be quick. One of its advertising slogans has been, "We are where you want us to." Just the introduction, it's a retailer selling food, small household goods. It has outperformed its competitors, beaten its competitors, provides high quality products, reasonable cost. It also has a presence online. It has kept a cost control, does not operate large stores on expensive city centers, and has smaller stores on edge. Okay. Westparlay's share price has recently performed better than most of companies in the retail sector generally. So this is something important, that its share price has recently performed better than most companies. Share prices in the retail sector have been relatively low as a result of poor results due to high competition, large fixed cost base, and high interest rates. The exception has been shares in retailers specializing in computer and high technology goods. These shares appear to have benefited from boom generally in share prices of high technology companies. Some analysts believe that share prices of many companies in the high technology sector are significantly higher than rational analysis of their future prospects would indicate. So this is an important paragraph, that Westparlay's share price has recently performed better than most companies. Share prices in retail sector are low due to poor results, high competition, large fixed costs, high interest rates. Exception has been retailers specializing in computer and high technology goods. Those who operate in technology sector, they have an exception. Otherwise, the share prices are generally low. Some analysts believe share prices of many companies in high technology sector are higher than rational analysis of their future prospects. Comparing in the future, share prices are usually higher. Metaverse company. Westparlay has identified sorry. Okay. From the two paragraphs, we just got to know that it's a retailer has outperformed, beaten competition, and share prices of these companies who are using technology as well are significantly higher compared to what analysts believe. Now, Westparlay has identified the listed retailer Metaverse company as an acquisition target because it believes Metaverse shares are currently undervalued and part of Metaverse operations would be a good strategy fit for Westparlay company. So Westparlay has identified a listed retailer, its Metaverse company, as an acquisition target it wants to buy. And it believes that Metaverse company shares are currently undervalued and part of Metaverse operations would be a good strategic or fit for Westparlay company. So Westparlay has identified a listed retailer Metaverse as an acquisition target. It believes that Metaverse shares are currently undervalued. Part of Metaverse operations would be a good strategic fit. Let's pause here for a moment. And make a quick summary. Westparlay. Beaten competitors. Second paragraph, share price boom. And third paragraph, Westparlay is interested in acquiring Metaverse. Okay. So Westparlay has identified a retailer Metaverse company as an acquisition target because it believes Metaverse shares are currently undervalued and part of Metaverse operations would be a good strategy. Metaverse operates two types of stores. So Metaverse, what we are trying to buy, has two types of stores. Metaverse Home mainly sells large household items and home furnishings. These types of retailers have performed particularly badly recently, and one of major competitors of Metaverse Home has just gone out of business. Metaverse Home operates a number of city center sites, but has much higher proportion of out-of-town sites than its competitors. And second is Metaverse Tech. It sells computers and mobile phones in much smaller outlets than those of Metaverse Home. You see, you visit many departmental stores, it has two sections, some technology and food and some home. So Metaverse operates two types of stores: home, where home furnishings, they have performed badly, and Metaverse Tech, which sells mobile phones. Extracts from Metaverse latest annual report are given below. Now see the Metaverse latest annual report. Metaverse operates two stores. Pre-tax profit is 1950 million. Long-term loan is 6,500 million. Share capital, $1 share is 5,000. That means number of shares are 5,000. The share of pre-tax profit between Metaverse Home and Metaverse Tech was 80-20. So pre-tax profit is 1950 million. The share of pre-tax profit between Metaverse Home and Metaverse Tech is 80-20. Now, since I have read too much of this question, I just want you to make a quick recap of that. The first paragraph states Metaverse is a listed retailer. It sells food and household goods. It has outperformed its competitors. High quality products, reasonable prices, online presence. It has kept a control of costs. Okay. Advertisement slogan: we are where you want us to be. Westparlay's share price has recently performed better than companies in retail sector. Share prices in retail sector have been low due to poor results, high competition, large fixed costs, high interest rates. Exception has been shares in retailers specializing in computer and high technology goods. Some analysts believe share price of many companies in high technology sector are higher than rational analysis of their future. This happens in stock prices, okay? That prices are significantly higher than we predict. Metaverse. Westparlay has identified a listed retailer Metaverse as an acquisition target, okay? So Westparlay is interested in acquiring Metaverse, okay? It believes shares are currently undervalued of Metaverse, okay? Metaverse operates two types of stores: home and tech, okay? And extracts from Metaverse P&L is pre-tax profit, long-term loan, share capital. That means 5,000 is the capital, one par value. It has 5,000 million shares. Share of pre-tax profit between Metaverse Home and Metaverse Tech is 80-20. That means 1950 is the pre-tax profit, and home is 1560 million, 80%, and tech is 390 million. This is an important part of the exam, that whatever information you are generating, you must quickly note them so that you don't have to go back again and again to the same information. Now listen, the current market value of Metaverse shares is 12,500 million. Now pay attention to this. Metaverse has 5,000 shares. And market value of shares is 12,500 million. So just for check, 12,500 million is the market value of 5,000 shares. Its share price is 2.5 per share. Its debt is currently trading at book value. So debt is trading at book value. Westparlay believes it will have to pay a premium of 15% of Metaverse shareholders to buy the company. So it has to pay a premium above 15% to shareholders to buy the company. Westparlay intends to take advantage of the current values attributed to business such as Metaverse Tech by selling this part of Metaverse company at the relevant sector P ratio of 18, rather than a forecast estimate of Metaverse Tech present value of future free cash flow of 45 million. Now pay attention to this. Westparley intends to take advantage of current values attributed to business such as Metaverse Tech. This is only talking about Metaverse Tech. Westparley intends to take advantage of this Metaverse Tech by selling this part of Metaverse company at relevant sector P ratio of 18. Sector P ratio is 18, rather than forecast estimates of Metaverse Tech present value of future free cash flows of 4,500 million. Now you need to pay attention to that Metaverse Tech, the 20% business, its relevant sector P ratio is 18, and it's the free cash flows, future free cash flows, that's present value of future free cash flows, that's 4,500 million. Okay. The company tax rate for both companies is 28% per year. Okay. Tax rate is 28% per year for both companies. Okay. Now, the post-acquisition cost of capital of the combined company will be based on its cost of equity and cost of debt. Obviously, the post-acquisition cost of capital will be based on combined company, cost of equity, cost of debt. The asset beta post-acquisition can be assumed to be both companies' asset betas weighted in proportion to their current market value of equity. This is very easy. It has been tested many times in the exam as well, that the post-acquisition asset beta can be assumed to be both companies' asset betas, individual asset betas weighted in proportion to current market value of equity. Westparley has $4,000 million one shares in issue, currently trading at 8.5. It has 26,000 debt in issue, trading at 105 per 100. Its equity beta is 1.0. This is for Westparley. Metaverse asset beta is 0.75. Its asset beta is given. Market value of Metaverse is 12,500 million. Long-term loan is trading at book value of 65. Westparley Metaverse. One beta equity is given, one asset beta is given, and it's stated that asset beta post-acquisition will be asset betas weighted in proportion to market value of equity. RF risk-free rate of return 3.5%, premium 8%. The pre-tax cost of debt of the combined company is 9.8%. Pre-tax cost of debt. It can be assumed that debt to equity ratio of the combined company will be same as Westparley's current debt to equity ratio in market value. So debt to equity ratio will be same as Westparley's current debt to equity ratio. What is Westparley's current debt to equity ratio? Westparley has 4,000 million shares trading at 8.5. So its market value of equity is going to be $34,000 million. Okay. 8.5 into 4,000 million shares. Okay. And debt market value will be 26,000 million debt trading at 105 by 100. So debt market value will be 27,300 million. If I see that equity market value is 34,000, and debt market value is 27,300, that means the total capital structure is 61,300 million, right? Equity market value is 34,000 million and debt market value is 27,300 million. So if I add both of that, the total is 61,300 million. So total is 61,300 million and equity is 34,000 million and debt is 27,300 million. So if total is 61,300 million and equity is 34,000 million, we can take the percentage as well. 34,000 over 61,300. It's approximately 55.5%. And second one is going to be 27,300 debt divided by total is 61,300, 44.5%. So we can say that equity is 55.5% in Westparley and debt is 45.5%. How did I find it? I just told you that the question states that the pre-tax cost of debt of the combined company is expected to be 9.8%. Okay, pre-tax cost of debt is going to be 9.8%. Can be assumed that debt to equity ratio of combined company will be same as Westparley's current debt to equity ratio market values. So market value of debt is Westparley 4,000 million, 8.5, 34,000 million, and that is 26,000 book value trading at 105 per net. I add both, the total is 61,300 million, and out of that equity is 34,000, that is 27,300. I just took out percentage 55.5 and 45.5. The tax rate for both companies is 28% per year. So the second time it's stating the same thing. Tax rate for both companies 28%. Plans for Matterverse company. The offer for Matterverse will be a cash offer. Any funding required for this offer will be a mixture of debt and equity. Also, for the purpose of calculation, it has been assumed that the overall mix of debt and equity will remain the same. The directors are considering various plans for funding the purchase, which could change in Westparlay's company's gear. So the offer for Matterverse, who is buying Matterverse? Westparlay. So Matterverse offer will be a cash offer, right? Any funding required will be mixture of debt and equity. Although for the purpose of calculation, it has been assumed that the debt to equity will remain same. Directors are considering various plans for funding, which could result in change. As soon as it acquires all of Matterverse share capital, Westparlay would sell tech as it does not fit in with Westparlay's current strategy plans. Westparlay wishes to take advantage of large values currently attributed to high technology business. Now, this is important. As soon as it acquires Matterverse, it has two business, home and tech. Westparlay would sell Matterverse tech. Westparlay would then close home worst performing city center stores. Then close home worst performing stores. It anticipates that the loss of returns from these stores will be partly compensated by higher online sales generated by increased investment in its online operations. The remaining city center stores and all out-of-town stores would start selling the food and household items currently sold in Westparlay, and Westparlay believes it will increase profits from those stores. What are the plans? This is important. They will pay cash for Matterverse, okay? And once they acquire Matterverse, they would sell its tech business, close its home worst performing centers, shift to online, and the remaining stores would also start selling Westparlay's food products so that profits increase. Westparlay also feels that reorganizing Matterverse administrative functions and using increased power as a large retailer can lead to synergies after the acquisition. Okay, these are the plans. Once Matterverse tech has been sold, Westparlay estimates that revenue from Matterverse home stores, which remain open together with the online sales, will be 43260 million in the first year, and this figure is expected to grow by 3% per year in years 2 to 4. This is important. That once tech has been sold, Westparlay estimates the revenue from home stores which remain open with online sales will be 43260 million in the first year and will be growing by 3% per year in 2 to 4. Profit margin before interest and tax is 6% of revenue in year 1 to 4. This is operating profit margin. Tax allowable depreciation is equivalent to the amount of investment needed to maintain existing operation. That means TAD is same as working capital. However, investment in assets will be required of 630 million year 1. In year 2 to 4, investment will be 0.5 for every $1 increase in revenue. After 4 years, the annual growth rate of free cash flow is expected to be 2% of the foreseeable future. As well as the free cash flows from Matterverse, Westparlay expect post-tax synergy will also rise from its planned reorganization in the next 3 years. Free cash flows year 1 to 3. Current market value of Matterverse is 12,500 million. Debt is trading at book value of 65. Okay. I think all information has ended now. So before moving towards the requirements, whatever I have written, I want you to note this as well. First note this, and then I will move the screen further. Okay, now, so let's just quickly do the requirements. I'm going a bit fast now because it's revision now. Westparlay, as per paragraph 1, is a listed retailer. It's selling food, household goods. It has outperformed its competitors, high quality products, reasonable prices, strong presence online. Westparlay's share price has recently performed better than companies in retail sector. Share prices in retail sector are low, poor results, high competition, large fixed costs. Exception has been shares in retailers specializing in computer and high technology goods. Technological sector retailers which offer technology products are higher, else lower. Shares appear to have benefited from boom in share price of high technology companies. Some analysts believe share price of many companies in high technology sector are significantly higher than rational analysis. Second, Metaverse. Westparlay has identified Metaverse as acquisition target. Okay, Metaverse has two types, home and tech. Okay, pre-tax profit is split in 80-20. Okay, share price is 2.5 per share. Current market value 12,500 million, and a premium of 15% needs to be paid. Westparlay intends to take advantage of current values attributed to businesses such as Metaverse by selling part of business at relevant sector P ratio of 18 rather than forecast estimate of present value of cash flows. Okay. In this sector, the confidence, the high technological sector, so P ratio is very high, 18. So they want to use this advantage. Post-acquisition cost of capital of the combined company will be based on KE and KD. The asset beta post-acquisition can be assumed to be both companies' asset betas weighted in proportion to market value of equity, which is already given. Okay, so market value of equity of Westparlay is this, and for Metaverse, that was 12,500 million. It has 26,000 million debt in issue trading at 105 per 100. Metaverse asset beta is given, here equity beta is given. Market value of Metaverse is 12,500 million. Long-term loan is trading at 6,500 million. Risk-free rate of return 3.5, premium 8%. The pre-tax cost of debt of the combined company will be 9.8. It can be assumed debt to equity ratio of combined company will be same as Westparlay's current debt to equity. So I just calculated that Westparlay's equity market value of this, debt market value of this, total is 61,300 million. We take the proportion 55-45. That's going to remain the same post acquisition. Tax at 28%. What are the plans for Metaverse? Cash offer. Funding required will be a mixture of debt and equity. As soon as Metaverse is acquired, it will sell Metaverse tech and close its worst performing home stores and shift to online. And they will also sell the food products offered by Westparlay. Westparlay will also get synergies, post-acquisition details. Once Metaverse tech has been sold, Westparlay estimates revenue with online sales will be 43 to 60 million first year and will grow by 3% 2 to 4, and profit margin 6%. TAD is equivalent to working capital. Investment in assets will be 630 million in year 1 and 2 to 4 will be 0.5 every one increase in revenue. 4 years growth rate will be 2%. This is all about free cash flows and synergies is also getting, and market values. Discuss the behavioral factors. Requirement 1. Discuss the behavioral factors which may have led to business such as Metaverse tech being highly valued. You are not asked general factors due to which technology companies are highly valued. Only the behavioral factors. Behavioral factor means the human behavior factors which have led to tech companies being highly valued. Behavioral factors and factors are different. If it asks factors which may have led to high tech values, obviously there may be factors that tech companies have highly performed. There are scenarios like it happened in COVID time that the companies, tech companies, business increased, etc., etc. These are the external factors. When it asks for behavioral factors, human behavior, what are the human behavior factors which may have led to tech companies being highly valued? There are 3 human behavior factors which led to usual increase or rise in valuation of the company. I'm not obviously writing the complete answer and just stating you the points, and you can then read the answer. Herd behavior. What are the human behavior factors which lead to increase in tech companies' value? One is called herd behavior. Herd behavior, what is a herd? We have seen many animals in a herd, all moving in the same direction. What is the herd behavior? It's just that since everybody is buying tech stocks, let's buy that. So when a herd comes, Demand creates, the prices go up, the values go up. This happens in stock markets as well, herd behavior. People buy some shares. What are the factors that increase share price? So factors that increase share price are good performance of the company, external factors, government subsidies, etc. But there is a behavior factor which increases prices of any company. Just buy simply because others are buying. So when you are buying simply because others are buying, this herd creates demand, which increases prices. So one herd behavior is the human behavior, which increases prices of any company, which increases value. Second is fashion. There's a fashion. We must have tech companies in our portfolio as well. Okay, so when something is going in fashion, you know the demand increases, and obviously that increases share price. Okay, why you are buying Siemens? It's a fashion to keep Siemens shares in our portfolio. Why are we buying tech companies? It's a fashion to keep tech companies in our portfolio. This also increases price and bias. People have seen some previous scenarios, like in the era of COVID previously, when when technological companies were the only source of online and offline working. People have a sense of bias towards that companies. This encourages them to buy them, which increases demand and increases share price. Okay, so these are the three behaviors, human behaviors. Obviously, to ask why tech companies are valued highly, other factors, maybe government have given them incentive, maybe they have performed better, but these are normal factors. Behavioral factors are only these three. Okay, you can copy these, please. Okay, now let's move to the second requirement. Prepare a report for the board of directors of Westparlay company. You need to prepare a report for the board of directors of Westparlay company, which compares the additional value which Westparlay believes can be generated from sale of mattress tech. Please pay attention. Compares the additional value which Westparlay company believes can be generated from the sale of mattress tech based on P ratio with that of projected present value of its future free cash flows. You need to prepare a report for board of directors of Westparlay, which compares the additional value which Westparlay believes can be generated from sale of mattress tech based on P ratio. You are asked to compare the additional value which Westparlay believes it can be generated from sale of tech based on P ratio with that of projected present value of future free cash flows. Obviously, if you value mattress tech based on P ratio, some other value will come. And if you value mattress tech based on cash flow method, the value is different. So you need to compare the additional value which will be generated from this tech company based on P ratio and the cash flow method. And then second, calculates the weighted average cost of capital of the combined company. Okay, third, estimates the total value which Westparlay shareholders will gain from acquisition of mattress company and assesses the strategic and financial value to Westparlay of the acquisition, including a discussion of estimates and assumptions made. Professional marks will be for the format and presentation. Okay. Those who have studied from me, they know my report format, because in part B, you have to make a report. Okay. And usually I tell you that when we have to make a report, obviously there are professional marks at stake as well. We start with to, from, date, subject, and okay. So if you read the requirement, prepare a report for board of directors. So report is to board of directors. From, nothing is mentioned, so leave it. Had it said prepare a report from the point of view of management accounting, from the point of view of finance manager, so from finance manager, else leave it. Date, never mention the date. It's just DD MMYY cross. Subject, it should be of 2 words, like the company you are acquiring. Mattraverse acquisition. Okay. Introduction. So in introduction, you have to write this report and write all requirements. This report and write all requirements, like this report. Requirement 1, compares additional value generated from sale of mattress tech based on P ratio with that of free cash flow. So this report compares created from mattress tech based on P ratio with that of value based on free cash flows. This is the requirement 1. It then, what is the requirement 2? Calculates the WACC of the combined company. Calculates WACC of the combined company. It then, third requirement, estimates value which shareholders will gain from acquisition. additional value. Westparlay's shareholders will gain from acquisition of Metaverse company. It then assesses strategic and financial value of acquisition. This is the first page of the report. Two from date subject introduction to board of directors from dash date dash dash s and subject Metaverse acquisition. Introduction, all requirement. This report, first requirement, and then second requirement, and then third requirement, then fourth requirement. Okay, till the requirements are over. Please copy this quickly. Okay, after writing the introduction, my report format is you need to write headings of all requirements. Like requirement one is additional value created, first heading, then WAC, second heading, then third, additional value for Westparlay, and fourth, strategic and financial value. Okay, whatever requirements are there, right, heading of each requirement, and if that requirement is a discussion requirement, start writing answer below that. But if it's a computation requirement, computation can only come in appendix, not in the report. So additional value created seems calculation requirement, so this will be shown in appendix 1, states additional value created, blah blah blah. WAC is also a calculation requirement, so this will also be shown in appendix. Now it's 2. Appendix 2 shows WAC. Additional value of Westparlay, this also seems a calculation requirement, so appendix 3 shows additional value, but discusses the strategic and financial value, looks at theoretical requirements, so answer will start writing here. Okay, this is the format of the report. Now there is no obligation Now, there is no compulsion that you follow my format of the report. You can use your format, you can use the examiner format. It's just for professional marks. Different tutors have different approaches. So my approach is two from the subject introduction. In introduction, we write this report, first requirement, then second requirement, then third requirement, and so on. And then all requirements headings. If it's a computation requirement, appendix 1, appendix 2, appendix 3, refer to appendix, just the reference 1, appendix 1 shows additional value, appendix 2 shows back. But if it's a theory requirement, just start writing there. Okay, we will do step by step with the first one. Okay, now let's move towards the first requirement. The first requirement is that you need to compare additional value which Westparlay believes can be generated from sale of Macroverse tech based on PE ratio with that of projected present value of its future cash flow. So I need to compare additional value which Westparlay believes can be generated from sale of Macroverse tech based on PE ratio with that of projected present value of future free cash flows. Macroverse tech only, right? Now, this is from this paragraph. Westparlay intends to take advantage of current values attributed to business such as Macroverse Tech by selling this part of Macroverse at relevant sector P ratio of 18. So Westparlay wants to sell Macroverse Tech by P ratio of sector 18 rather than forecast estimate of Tech's present value of future free cash flows for 500 billion. So it's just that Westparlay intends to take advantage of current values attributed to business such as tech by selling this part of Macroverse at relevant sector P ratio of 18 rather than forecast estimate of present value of future free cash flows. So as you can see that this requirement is just of 4 marks. So it's not going to be too tough. You just need to compare the additional value which Westparlay believes can be generated from sale of Macroverse Tech based on P ratio with that of project's present value of future free cash flows. You just need to compare additional value by selling Macroverse Tech on P ratio compared to present value of future free cash flows. Now, if we sell Macroverse Tech on P ratio, value will be. So if you sell Macroverse Tech on P ratio, value will be. What is the formula to get value under P ratio? Under P ratio, the value is PE ratio of sector average into PAT. Under PE ratio, the value is PE ratio of sector average into PAT. So what is the P ratio of sector average? Is 18. And PAT of Macroverse Tech, PAT of Macroverse Tech. You see that Macroverse Tech's pre-tax profit is 390. So PAT will be 390. This is pre-tax profit, so PAT will be less 28% tax. So to 80.8 into 18. The tax is 28%, right? So it's 280.8 into 18. It's 5054.4 million. This is the value if we sell mattress tech on P ratio. Now in requirement 1, you are asked to compare additional value created by selling mattress tech on P ratio compared to present value of its free cash flows. Its present value of future cash flow is 4,500 million, right? As given in the question. So the additional value, if we sell mattress tech on P ratio compared to that of the present value of future free cash flows, is going to be 554.4. Okay. So the answer of requirement 1. If you can go and see the requirement 1. It's clearly seen that you need to compare the additional value which Westparlay believes can be generated from sale of mattress tech based on P ratio with that of present value of future free cash flows. You just need to compare the additional value which can be generated based on P ratio rather than present value of future free cash flows. It's given that present value of future free cash flows, it's 4,500 million. So additional value on P ratio, it's P ratio of sector average into PAT. I just calculated PAT. Additional value is 554.4. Okay, you can copy this, please. Now I'm moving towards requirement 2, WACC of the combined company. My requirement 2 is WACC of the combined company. It's a complete paragraph given post-acquisition cost of capital. WACC is cost of capital. So I will just tell you about post-acquisition WACC of the combined company. That's what I'm saying. Okay. Okay. WACC of the combined company. The post-acquisition cost of capital of the combined company will be based on KE and KD. Okay, so pay attention. The post-acquisition cost of capital will be based on cost of equity, KE and KD. The asset beta post-acquisition can be assumed to be both companies' asset betas weighted in proportion to their current market value of equity. Westparlay has 4,000 million, one shares trading at 8.5. Its market value of equity is 34,000 million. 26,000 million debt trading at 105 per hundred, equity beta 1.0. Mattress asset beta 0.75, market value of equity is 12,500, long-term loan is 6,500 million. Risk rate 3.5, market premium 8%, pre-tax cost of debt 9.8%. It can be assumed debt to equity ratio of the combined company will be same as Westparlay's current debt to equity ratio, that is 55:45. Okay, I need to calculate the cost of capital of the combined company. I'm moving towards that. So if the question is asking you cost of capital of the combined company, it's clearly mentioned cost of capital of the combined company, WACC, will be based on KE and KD, cost of equity K and cost of debt KD, which is 1 minus T always. So KE and KD means KE on equity portion. There are two things, E over E plus D, and KD on debt portion, D over E plus D. Now, cost of capital of the combined company, it's clearly written, will be based on KE and KD. So I made the equation, it's KE plus KD into their respective portions. Okay, it's written that the debt to equity ratio of the combined company will be same as Westparlay's current debt to equity ratio market value. So debt to equity ratio of the combined company, the proportion of debt and equity will be same as Westparlay's current. So Westparlay's current is 55.5% equity portion and 45.5% debt portion. So the debt to equity portion will remain same, 55.5%. The equity portion, equity over total, that is 27, sorry, what was that? 34,000 over 61,300, right? You can even write here 34,000 equity over 34,000 plus 27,300. That's 61,300, makes 55.5%. And debt portion, you can write as 27,300 over 34,000 plus 27,300. Okay. Or you can write 55% and 45%, that's the same. Why you have written sort of same as past Westparlay? This one was for Westparlay. Why you wrote the same? It's clearly written, can be assumed that debt to equity ratio of combined company, I'm finding the combined company back, will be same as Westparlay's current debt to equity ratio. So I've written same as Westparlay. Now, KD, cost of debt after tax. You can see the question states, the pre-tax cost of debt of the combined company will be 9.8. Post-tax cost of debt, it's 9.8%, 1 minus 0.28. You got post-tax cost of debt. And for KE, you need to do a working. Okay. Risk rate of the combined company is 3.5, premium is 8%. So RF is 3.5, premium is 8%. You just need combined companies beta equity. Premium is 8%. You just need combined companies beta equity. That would be it. So you just need KE to get the combined company cost of capital. It's RF plus RF minus RF beta equity. And you have RF, you have premium. You just need combined beta equity. Now, you know, combined beta equity is through the formula of beta asset that's given in the exam, beta equity into equity portion. But here 1 minus T comes plus beta debt into debt portion. Here also 1 minus T comes. Now combined beta equity is required. Combined companies market value of equity is same as that of Westparlay. No beta that given is 0, so whole bracket will become 0. Now you need combined beta asset, because once you get this combined beta asset, everything will be smooth for you. Now, what does the question states about combined beta asset? The question states the asset beta post acquisition can be assumed to be both companies' asset betas weighted in proportion to market value of equity. So the asset beta post acquisition is both companies' asset betas weighted in proportion to market value of equity. Okay, so market value of equity of Westparlay is this 34,000, and market value of equity of Matravers is 12,500. Asset beta of Matravers is given, but for Westparlay's equity beta given, I will convert it into asset beta. Okay. So combined beta asset is the weighted average of individual asset betas in relation to their weights. So beta asset of Matravers is given as 0.75. Beta asset of Westparlay you can find by the same equation. Beta equity is 1.02. Market value of equity of Westparlay is 34,000. Over 34,000 plus 27,300 is the market value of debt. 1 minus 0.28. No beta debt given, so 0. So beta asset will be 0.65. So you have the beta asset of Matrix company and beta asset of Westparlay. Now the combined beta asset is the beta asset of both Westparlay and Matrix. But they will be weighted in proportion to market values equity. They need to be weighted in proportion of market values of equity. Obviously, you cannot just add both. They need to be weighted in relation to market value of equity. So just multiply them by the market value of equity over total. So market value of equity of Matrix, I think, was 12,000. And here it was 34,000. So 12 plus 34 is, it's 34,000 and 12,500, sorry. You need to apply weights, 34,000 and 12,500. So 34,000 over 34 plus 12,500, it's 46,500, and 12,500 over 46,500 total. So this will produce the combined beta asset as 0.65 into 34,000 divided by 46,500, just applying market value of equity, not the market value of company. So this makes it 0.68, the combined beta asset. Once you get the combined beta asset, you place the combined beta asset here, you will get the combined beta equity. So it's 1.074, and when I put 1.074 here, the combined beta equity, 12%. The combined K 12% was missing. I copied it here. Okay, so 12%. It's approximately 9.9% or 10%. This is your 6-month requirement. You have found the WACC as well. Let me repeat it quickly, then you can copy. Cost of capital of the combined company will be based on KE and KD. KE, KD. Okay. So K into equity portion of the company and KD into debt portion. KD of the combined company is given. Their market values of equity and debt will be same as Westparlay, 34 and 27,300. You just need combined KE. For combined KE, RF plus RM minus RF beta equity, RF and RM minus RF was given. You need combined beta equity. You use the beta equity equation. The debt to equity ratio of the combined company were same, but you need combined beta asset. How to get combined beta asset? It's written. It's the weighted average of Westparlay and MATS in relation to their market value of equity. I have the beta asset of MATS, but I had the beta equity of Westparlay. No, I had the beta equity. I didn't have the beta asset. So from beta equity, I found the beta asset of MATS, added them both, applied the weights in relation to market value of equity. I got combined beta asset. When I placed combined beta asset here, I got combined beta equity, and then I put combined beta equity here to get combined. This is combined cost of capital. Okay, copy it, please.